Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. The competition between BRIC members China and India is intense. Right now, you'd think China is winning with the world's #2 economy by GDP. India is currently #8. But when you look at both economic and public company data, it may be premature to count out India just yet. Data stream charting indicates the last decade of investing has favored India. If you include dividends, the Thomson Reuters TR India Stock Index gained almost 600%. The TR China Stock Index jumped almost 90%, and the S&P 500 rose 115%. Since the stock market highs in the US in October 2007, the TR India Stock Index is flat, but China is down by 50%. So far, 2012 has been kinder to Indian companies with over 20% equity index gains compared to China's 3% decline. Let's see what current macro forecasts say about the economic growth potentials of China and India. Using Oxford Analytics year-over-year GDP growth projections and data stream charting, India could bottom this year. That's ahead of the projected bottom in China. Now, let's turn to firm StarMine tracks in these countries. The predicted surprise for Chinese company earnings this year currently stands at -2.9%. The predicted surprise is the percentage point difference between StarMine's smart estimate and the mean estimate. India's predicted surprise is less pessimistic at -1.5%. Both countries are expected to grow earnings by 13 to 15% over the next 24 months. However, the forecast for top-line revenue growth in China is higher at 11.7% compared to India's 9.5%. Looking at earnings over the next 5 years, we see 8.6% growth for China, though the market is actually pricing in a 1.9% decline. India's current 9% growth rate is priced today as if earnings will only grow at a 2.8% compound rate. Based on this, both countries appear cheap, but China is cheaper, maybe in part over concerns about its overheated real estate market. And then there's the recent economic reform proposal of India's President Manmohan Singh. That plan includes opening foreign direct investment, or FDI, in the retail sector to supermarket chains like Walmart and Tesco. The move could repeat the success then Finance Minister Singh had 2 decades ago when he opened the country's auto industry to FDI. That action fostered competition and kick-started growth. While Singh's goal is to help the Aam Aadmi, or common man, equity investors may also benefit from this tailwind of reform. The market rallied following Singh's speech, perhaps expecting India's parliament to encourage even more FDI. In spite of India's more favorable media attention, the TR India Stock Index beats the TR China Index on a 1-year, 5-year, and 10-year basis. That gap could widen if India's proposed economic reforms are enacted. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.